Welcome. I am Kimani Woods. I'm the communications manager here at TimeWise Financial, and we look forward to talking about the election and their effect or lack thereof on the market. Matt is going to be presenting this webinar, and we just want to make sure that you guys understand that this is completely unbiased. Everything is based on data or based on research. And so, while we are going to be dealing with a tricky subject, we just want to make sure that you all understand that we know that everyone has different personal opinions, and we are just going to focus on what data tells us about this topic. So, Matt, just to let you guys know as well, if you have any questions, you feel free to please chat them. It will be sent to both Matt and I, and we will make sure that we answer them to the best of our ability at the end of the presentation. So Matt, you can get started.
Well, awesome. Thank you, Kimani. So firstly, I want to welcome everyone and thank you guys for joining. And we have a lot to cover today. So we'll start off with, is this really the most important election in our nation's history and how elections have affected the market in the past, as well as what has historically been the best outcome. And then we'll look at some of the factors that are at play in this particular election. And so, as Kimani said, if you have any questions that come up during this presentation, feel free to drop them in the chat and we'll answer them at the end or either follow up with you afterwards. So let's jump right in. So firstly, is this really the most important election in our nation's history? So I snipped this from Google, and so already people are saying this is the most important election that's ever happened. But I think we could argue there's some elections in the past that were a lot more important, whether it be the election of 1860, which catalyzed the Civil War, or the election of FDR coming out of the Great Depression, instituting, Social Security and the New Deal. There've been a lot harder times this country has faced and arguably much more important elections. So the media is going to hype up any election just to get more views and clicks, but we have two repeat candidates, one from the vice presidency seat and one former President Trump from 2016 that we know a lot about. And fortunately, times are arguably stable relative to those times we just mentioned. So let's talk about how the market's done. And this chart just simply shows the trajectory of the market under each administration. And you can see, barring Nixon here and Bush here, the markets tend to trend upwards no matter who's in office, Republican or Democrat. And how that plays out in percentage points, as you can see, since Dwight Eisenhower, there's really only been two presidents that have had negative returns during their administration. And some may argue, Nixon was dealing with Vietnam, Bush was dealing with 9/11 and then the great financial crisis. But I think that just goes to help prove our point that whoever's in office doesn't really matter. The exogenous events that are occurring in the world have a much greater impact on market returns than the executive administration. That being said, let's look at which outcome typically tends to perform the best and why. And so here you can see what happens if a Democrat is elected president versus a Republican under a few different outcomes. So if we have a clean sweep, Democrat and Democratic Congress, or a clean sweep Republican and Republican Congress, you can see the corresponding performance there versus a Democrat and clean sweep on Republican Congress or vice versa. But what this chart really goes to show is that the best outcome is a split Congress, where there's some checks and balances in place and really change and legislation comes to a halt. And it takes a lot of bipartisan deal making for anything to get through to the president to sign. So that, I guess, slow rate of change that's imputed with a split Congress means there won't be many surprises to the market with some new bill, some new legislation that could create a shock in the market environment. So really, the best outcome really doesn't matter who wins the executive branch, but for us as investors is a split Congress. And this just further analyzes that from a different scope. So it looks at the 3-month period after an election is announced. And so it shows the different possible scenarios as well as the average 3 month return relative to all the other 3 month return periods. And what I really like is it shows which of these actually have any sort of statistical significance, which of these outcomes. And you can see only three of them create either a less or more desirable market outcome relative to the possible outcomes available. And you can see a White House control with a Republican Congress or White House control by the Democrats with a split Congress have great upside potential. That the market really likes that gridlock that happens in those scenarios versus the switch side where a Republican takes White House control and the Democrats sweep Congress actually has a negative impact on the market, historically speaking. Otherwise, there isn't really any statistical significance to one party or the other winning the White House. Where it really starts to matter is at the congressional level, where all those bills get put onto paper, proposed, voted on twice, and then eventually, ideally, signed into practice by the acting president. So let's start to talk about this election. There's a few key issues that voters, at least polled, tend to really care about. The economy, healthcare, and foreign policy are right up there towards the top. So just to educate some of our clients who maybe have stayed away from the media a little bit, we want to talk about where each candidate stands on those issues. And then we'll talk about an issue that we feel like might have the biggest impact or potential impact on the market. So as far as the economy goes, Vice President Harris has proposed some mortgage assistance for first-time home buyers, upping the child tax credit, and banning price gouging at the grocery store through potential price controls. On the healthcare aspect, she once was a supporter of single payer or federalized healthcare. That's been since rolled back in this election, and she just aims to expand ACA coverage for individuals and expand drug cost negotiations. As far as foreign policy goes, Harris has outlined a plan to roll out as much aid for as long as it takes to ensure that the sovereignty of Ukraine is protected and that therefore the sovereignty of other European nations. And she's basically said if it takes a blank check, we'll do it. On the flip side, Trump he wants to reduce taxes on corporations ever so slightly, as well as introduce some tariffs from an economic perspective. In his eyes, it's not necessarily a fair playing field to some of these companies that are producing goods here in the U.S. relative to the greatly reduced labor costs and other factors at play overseas. And so his idea to even that playing field would be to incentivize Americans to buy American and add tariffs to imported goods. As far as healthcare goes, he's a 100% a proponent of private health insurance, but he wants and has continued to push for much more transparent pricing at healthcare institutions to include starting to, during his 2016 candidacy, force hospitals to roll out pricing sheets on their websites because oftentimes, in his eyes, there is subjective pricing for medical procedures. And then as far as foreign policy goes, he hasn't committed to providing any aid in addition to what's already been provided to Ukraine, and has rolled out a much more isolationist philosophy of that's their problem, let them deal with it, and we'll focus on the issues that in his eyes directly affect us. That being said, those issues in this election and historically will have muted effects on the market in relation to this issue, which we see as the one issue that could actually have some sort of impact on the market. We already showed you in the past that the candidate that wins, oftentimes it's more the events that occur during their candidacy that have the greatest impact on stock returns. But this particular issue, taxes, is where each of them have very differing philosophies and they could be shaken out into the market in a much different manner. It's important before I dive into this to note, one, there's plenty of checks and balances in place for any of these policies. I like to give an example. The Biden administration ran on student loan forgiveness, as much as 20 grand to all borrowers of student loans. And that continued to get scaled back and scaled back and scaled back because they realized that there was a great philosophy in their eyes, but they weren't able to get it through the additional checks and balances that were necessary to provide that student loan forgiveness to each of those borrowers. And now they started with a save plan. That was their Band-Aid on that proposal. And what that proposed is that if student loan borrowers made payments for 20 years, they could get their loans forgiven. And even that's now tied up in the courts, and they've suspended that plan until August of next year. So anything that happens in the world, whether it be 9/11 or the great financial crisis, there's typically policy change that happens afterwards to counteract that helps the market rebound. None of these doomsday scenarios that you hear on the media can happen in a vacuum. There's always a reaction that happens afterwards. But that being said, let's dive into each candidate's tax policy. So President Trump, he hasn't gave a clear number yet. He has been quoted saying he wants to reduce corporate tax rates by a point or two. But he's talked in the past about taking it as low as 15% for taxes on corporations. He also wants to end taxation on Social Security benefits and then impose those tariffs on international imports that we talked about. But more importantly, he has said that he would aim to extend the Tax Cuts and Jobs Act of 2017. So what that act did is it made it one where not many people itemize on their tax return anymore because that act doubled the standard deduction. Two, it lowered the corporate tax rate all the way up. It was from 35% to 21%. So a huge reduction in the corporate tax rate. And then there was some other incentives in there for small businesses. On the flip side, candidate Harris wants to raise corporate tax rates from 21% to 28%. She additionally wants to raise the capital gains tax for high earners from 20% to 28%. We talked about a few of those other policies, but one that really got a lot of news coverage was the unrealized gains tax. Where that policy stands right now is it would be a tax on asset appreciation over $100 million in a single year. Now that's where it's starting. Could it go less or more than that? More certainly, but at face value, that could be hard to enforce if it came all the way down to all earners. If you think about your home and your stocks in the market and all those things. But right now, she's pivoted that to be more of a target at the ultra high net worth individuals. Now, let's talk real quick about how each of these things could shape out into the market. Politics aside, the way each of our personal budgets work is we make a paycheck, whether it be from our IRA or from our job. We pay taxes to the federal government. We pay our fixed expenses at home, like our mortgage or just the food that we need to eat. But then ideally we have some money left over at the end of each month. And that's the money that we can take and go to Home Depot and buy some stuff to improve our home with. That's the money we can take to go out on a nice vacation. And if all of a sudden we saw 8 or 10 or 12% less of that money due to an additional tax, we would have to cut back a little bit. So the idea here is if corporate taxes went up, corporate earnings, net of taxes, would typically come down unless there was stimulus from other areas of the economy. And when corporate earnings come down, stocks are simply a multiple of a corporation's earnings. So if a company does really well on earnings, that's why you see after a quarterly earnings call, that stock will jump. If it does really bad, that stock will come down because essentially when you buy a stock, you're hoping to buy a company that has healthy earnings. And if those earnings take a hit in a overnight bill that was passed, you would expect valuations just to come down a little bit. On the flip side, the whole incentive behind rolling down these corporate tax rates is to get more competitive with international tax rates. So there's many corporations, to include Apple, Chick-fil-A, UPS, pretty much any company that can hire a sophisticated accounting firm, has set up bank accounts internationally in countries like Ireland and Singapore, because these countries have sub 15% corporate tax rates. So money that they realize and keep over there is not taxed at nearly as high of a rate as it once was here at 35%. So one of the strategies that is supposed about that tax rate reduction is to bring a lot of this money sitting overseas in corporate accounts home and then deploy it into and growing that company, hiring new people, expanding the infrastructure. And one could argue on the other side that it would just go towards stock buybacks or something like that. So there's not necessarily living proof that that's what would happen, but just want to give you some color as to the rationale behind that strategy. That being said, I get asked by clients all the time. So if this candidate is going to win, or if this candidate does win, what changes should we make in my account? Or this vice versa with the other candidate. And I just wanted to take a look at the past two elections, not to pick on any president or anything like that, but show how that might have played out in the past two elections. So in 2016, at the beginning of President Trump's candidacy, he named Rex Tillerson, a name you may or may have heard of, may or may not have heard of, his Secretary of State. And Rex was a former CEO of ExxonMobil. Additionally, Trump ran on a lot more domestic drilling and a lot more production and distribution here in the United States. You might remember some of the pipeline proposals. So one could have argued a very strong argument that, hey, if Trump wins, energy stocks, especially Exxon, since they've got an inside man on the staff, is going to do exceptionally well. Well, in reality, I compared during Trump's candidacy just a balanced investor relative to ExxonMobil stock. And you can see that starting with 100 grand at the start of Trump's presidency, the well-diversified balanced investor had a much more suitable ride. And one could argue that a majority of these losses from Exxon were due to the pandemic when oil consumption went to essentially zero. But even prior to that time, well-diversified balanced investor outperformed that bet that you could have made based on Trump policy. And the same goes across the energy sector during Trump's candidacy. So those policies didn't necessarily play out to companies' bottom lines. And that's where it can become dangerous to try to make a bet on a particular policy. Let's look at another example during the Biden administration. So Taiwan and China, Taiwan prior to the pandemic produced nearly 90%, 86% of every computer chip in the world, whether it be for your cars, your smart technology in your home, or your computers. They really had a monopoly on semiconductor production. And so when China started to threaten Taiwan and potentially totally disrupt that supply chain, it had some long-lasting ramifications other than the health and safety of the Taiwanese people that the American government wanted to hedge against. And so during Biden's administration, early in his administration, he rolled out the CHIPS Act. And the goal of this act, it was a multi-billion-dollar act, but $5 billion of those dollars were appropriated to help Intel build chip facilities in places like Arizona and Ohio. And as all this was coming out, one could have easily argued that, hey, Biden seems like an Intel guy. He's doing all he can to support that company. Or why shouldn't we add Intel to our portfolio? And so this chart just shows under Biden's administration, that same balanced investor thus far compared to Intel's performance. And you can see the balanced investor made money over that same time period, about 6% a year, whereas the Intel investor lost an average of 18% a year and has lost over 50% of their initial investment. So making this gamble based on a particular candidate's policy oftentimes doesn't necessarily play out well. And I wanted to show one more example of that, but because of the Green New Deal, which was a Biden policy that highlighted that many of us may be driving electric vehicles by 2035 and a much less reliance on non-renewable resources for energy production. But one could have heard all of that and made a bet on solar. And you can see the same plays out. So what we try to do here at TimeWise is for all of our clients, build out a well-diversified portfolio. We definitely want to take a look at market conditions and economic factors like interest rate cuts that we saw just yesterday and position our portfolios accordingly. But we're not trying to make a bet on any particular candidate and their policies because as we just saw, you can get burned if you do so. So by having a diversified portfolio, you ensure that you have some of those large cap growth stocks that did really well over the last 2 years, but prior to that weren't performing all that well. And you ensure you're not loaded up on Intel or solar energy or some of those positions that really didn't do well over the last 4 years. And additionally, the one thing I like to remind our clients is this asset class, bonds and global bonds, for a huge percentage of our clients, is a large allocation. And it operates somewhat independently of the market, much more tied to interest rates, like the cuts we saw yesterday, than the stock market is to a fickle jobs report or something of that nature. So rest assured, if you've got a well-diversified portfolio, especially as you approach retirement and you start to get more conservative and add some more of those bonds, as we enter a falling rate environment, historically, those bonds have appreciated in value independent of what has occurred on the stock side of the portfolio, whether your candidate or your policy gets passed or pushed through or not. So that being said, I wrapped up a little early today, but I think we might have a question or two. So I welcome anyone to ask us any questions, concerns, or anything they might have going through their head after seeing this information. But before we go to the questions, I want to thank each and every one of you guys who joined this discussion of, hey, how might the market play out if this candidate or that candidate wins and how it's historically played out for market cycles prior. I would really appreciate you guys taking the time to join us. But Kimani, were there any questions?
Hi, thank you so much, Matt, for presenting that. If you guys have any questions, I don't see any right now, which I am going to assume means that you did a great job. But if you have any questions at all, please just go ahead and add it to the chat. And we just want to make sure that you guys understand that the benefit of having a financial advisor and a financial advisory team is that you don't have to go through this alone. You don't have to go through the election cycle or what's going to happen after the election cycle by yourself. We are the team that is on your side. We are staying up to date and on all the information and all the updates of what's happening in the economy as well as in the political sphere so that we can make sure that your investments are diversified appropriately.